All right. Well, I just wanted to say hello and a warm welcome to everybody to our quarterly Council 400 virtual meeting. It's great to see familiar faces and newcomers alike. My name is Kevin Sullivan, and I'm here with Bernadette Conway, and we're delighted to have you all here today.
Hi, everybody. Yes, I'm Bernadette Conway. If you've never joined a meeting before, it's nice to see you here. And before we hear our speakers discuss this important subject, um, let's go over a few quick meeting guidelines. Firstly, all participants will be muted during our main presentation to ensure clarity for everyone. We encourage you to listen attentively to our speakers and save any questions until the end of the presentation. If you'd like to ask a question after the presentation, feel free to use the chat feature or signal by raising your hand. And you can raise your hand by clicking the participant's icon at the bottom of your screen, which will open a sidebar. There you'll find the raise hand option. Please wait patiently for your turn to speak. And out of respect for our special guest speakers and their extremely busy schedules, we will be ending the meeting at 5:30. If there are any questions that you would like addressed, you can feel free to reach out to me or Kevin after the meeting, and we'll work on getting answers for you. Kevin and I will be working hard to make sure all questions are answered, and we will be monitoring the chat during the presentation, so please be patient with us.
All right. Zoom now offers closed captioning. So to enable closed captioning, go to the bottom of the screen and click the Show Captions button to start viewing captioning. To enlarge the captions, click on the drop-down caret, go to the caption settings, click on font size, and slide the bar to the right to enlarge. We are excited to welcome our three guest speakers this evening. They are Kenneth Kohlmeyer, David Schwartzer, and Jan Kritzman. All three of these speakers have been working diligently to fix the problem many of you are familiar with, the escalating costs of long-term care insurance premiums. Before we start, I just wanted to give an extra special thank you to Jan, who is celebrating her 57th wedding anniversary today, and she's here with her husband, Harold. So thank you so much for taking time out of your important day to do this. I just wanted to remind everybody that there is limited time and we'll do our best to accommodate everyone's questions, but please remember that there are others waiting to have their questions answered as well. It's best to keep your questions general. If you have specific questions related to rare situations, please reach out to me and we'll work on resolving those. All
Okay,
right, at this time, we're going to pass it along over to Ken.
Thank you, Kevin. And good afternoon, Connecticut State Employees Association and Service Employees International Union members. My name is Ken Kohlmeyer, as Kevin mentioned, and I'm a Farmington resident for 40 years, a former general management business executive for Connecticut-based corporations such as Bloomingdale's by Mail, Moore Medical Corporation, and Nefco Corporation, and also a retired interim state director for the Small Business Development Center program, which was sponsored by the Connecticut State University System, the State Department of Economic Development, and the U.S. Small Business Administration. And I am, like you, a proud member of the CSEA. I come here before you and am very honored to introduce my Newington colleagues, Jan Kritzman, to probably you'll see here on my right, and David Schwartzer on my left. And Jan and her husband Harold are entrepreneurs and co-owner of the Old Town Coin Company, Inc., with husband Harold for over 50 years. They've owned this shop. They are buyers and sellers of rare coins and precious metals. And our colleague seated to my right is David Schwartzer, who is a retired insurance executive with over 40 years of industry experience. We became acquainted during the 2023 2024 timeframe and have become true teammates over the past 3 years with the common goal of righting the long-term care insurers' wrongdoings. The three of us, along with our spouses, have been long-term care insurance policyholders since 2004. My spouse Penny and I have policies with Transamerica. Jan and spouse Harold also have Transamerica, and David and spouse Judy have Genworth. Our team has been individually and collectively investigating the long-term care insurance premium crisis in Connecticut and advocating for corrective changes to our state laws since 2021. At this time, I would also like to recognize and say thank you on behalf of our team to CSCA's organizer, Mr. Kevin Sullivan, and his capable assistant, Bernadette, for providing us today's opportunity. When I first spoke with Kevin a number of weeks ago, he shared the CSCA's top 5 goals and focal points for 2026. And the long-term care and Medicaid, they were both featured on his list. Eureka, I thought to myself, Jan, David, and I may have found the opportunity to join hands with a very strong, game-changing organization and consequently an opportunity to collaborate to secure exponentially positive and meaningful success for all state long-term care insurance policyholders. We are also aware of one of your members, Miss Amelia Smith, and I know she's plugged in here today. And Amelia is a 91-year-old. I hope you don't mind, I mentioned your age, but a 91-year-old young, retired DCF teacher and long-term care insurance policyholder who testified earlier this year alongside Jan and David at a legislative public hearing. Amelia shared that her premium started at $80 a month when she purchased her policy in the early 1990s. But with a recent premium rate outlays exceeding $800 a month, $800 a month, you got that right, a tenfold increase, Amelia has been forced to eliminate nearly 100% of her non-essential and discretionary retirement spending, which included occasional visits with her family because she could no longer afford the long distance trips. Now, I am certain that most of you also have your stories for how you have been financially, mentally, and emotionally abused by the insurers and have questions for why the state government has pretty much been a bystander, watching this onslaught worsen while remaining ineffectual. Their behavior has been totally unacceptable, my friends. An old proverb expresses that if even one person is treated unfairly, an injustice has occurred that requires correction. Well, folks, we have 100,000 mistreated long-term care insurance policy holding persons in Connecticut who are still looking for meaningful financial, emotional, and mental relief from the skyrocketing premium rates that began 5 to 8 years ago. And I want to show you a graphic here of the one particular one particular long-term care insurance policyholder, and this is public information that this gentleman put into his testimony. And if you look at this graph, you'll see this is from years 2001 up until 2028. Of course, we haven't had 2028, but he's projecting because he's probably gotten the bills for what it's going to be. So you can see from like the first part of the graph visually that our premium rates were pretty stable. And then lo and behold comes 2018, 2019, and then before you know it, we're skyrocketing to the moon. We don't need to know any more detail in that, but that's what you've been experiencing. And that's what I've been experiencing. We've all been experiencing this, and it's scary. Okay, yeah. Okay, so it is clear to me that only you and us, we together, joining forces, can and will make such necessary relief happen, and that our collective cause has officially reached a higher level of intensity beginning right now. Ladies and gentlemen, you are in for 2 treats this afternoon, hearing what my 2 colleagues have to say. My colleague David Schwartzer will take the mic shortly, speaking for how the industry made monumental miscalculations by violating the insurance industry's sacrosanct law of large numbers, and how they made things much worse by not forewarning unsuspecting policyholders about the looming financial disaster that lay ahead in the weeds. The insurers have worked and are still working very diligently with insurer lobbyists and, mind you, with our paid in premium dollars to cover up their debacle. And this ongoing tactic seems to be working to their benefit, as the Connecticut Insurance Department, the CID, in our opinion, has been and is still prioritizing the insurer's profits over the policyholder's protection. Did you know that nearly 80% of all insurer long-term care insurance premium rate increase requests are either partially or 100% approved? So the message from the insurance department is basically, insurers, throw it against the wall and we'll see if it sticks. And by the way, most of it sticks. And did you also know that the insurers became aware of their troubling future as early as 2002, when new policy sales started to decline and then plummet? Long-term care insurance policies enforced nationwide peaked at 7.4 million policyholders in 2010, and 7.4 million policyholders, by the way, is a very small number in the world of insurance. The truth of the matter is that the long-term care insurance crisis is a premium crisis driven by insufficient policyholder numbers. It's not a claim crisis. I'll not say any more and steal David's thunder, but when he takes the floor, you folks will receive much more related high-level information in words you can understand. David has forgotten more about the insurance industry than I ever knew. I will return to the mic after David and will deliver a high-level rundown on the new long-term care insurance legislation, Public Act 2693. This state law, which was supported by 97% of all Connecticut legislators, that's amazing, is a foot in the door accomplishment for us policyholders. But more work is indeed needed, and that's where you come in. If we are going to overcome the continuation of these punishing premium rate increases, which 1986's Connecticut Statute 38A-501 continues to facilitate, this standing law must be changed, and or the new state law, Public Act 2693, will need to be amended. It is a known fact that Connecticut's loss ratio for long-term care insurance premium rate increases places the lion's share of the burden of insurers' financial shortfalls squarely upon us policyholders, and we did nothing wrong. But also know that some progressive states in the country, like Minnesota and Texas, for example, they have instituted laws whereby the insurers must take responsibility for their errors and are therefore being held accountable for a significant share of the burden as opposed to their policyholders. On the campaign trail, I don't know if you heard this on the news, but our Governor Lamont has recently commented, they, mega billions and millions healthcare corporations, have, millions or billions in profits, Lamont said. I think they can contribute rather than receiving corporate welfare asking us to pay their load. Now, that had to do with healthcare insurance, but the same idea is that like Walmarts are getting payments from the state, and yet they don't pay enough their workers to afford the health care insurance. So isn't this a seemingly similar situation to the long-term care insurance premium crisis, with one big exception? The governor has never, to the best of my knowledge, asked that the mega insurance and financial corporations reduce or cap long-term care insurance policyholder premium rate increases, because these very large financial entities are currently receiving corporate welfare from Connecticut taxpayers. Rather, Governor Lamont continues to allow the Connecticut Insurance Department to bail out the insurers by legally permitting them to mercilessly raise our premiums. Our colleague Jan Fritzman, seated, I think, to my right from where you're looking, will close this session, and she is our closer and lobby queen, affectionately referred to as lobby queen. Jan, my friends, is also the epitome of an unrelenting fighter of epic proportions that will battle to the end and will not quit. We need Jan on our side, folks. Jan strikes fear in the eyes of legislators when they see her approaching, because she's coming after them so that something that is clearly wrong will be made right and it will not be dismissed. Jan will review and explain what you need to think about doing starting today, and will explain how you can make a positive difference by doing some simple but important basic things in the spirit of making your voices heard often and loudly. We know the CSEA will have our backs because this is what you do year in and year out. In closing, CSCA members, we must continue to fight this ongoing Connecticut-based story of how the multi-billion-dollar insurers' ineptitude and the state's ongoing governmental negligence are stripping away our future independence and quality of life. Please help us and help yourselves by hearing us out today, by asking your questions today, and by signing up for David's no-charge, excellent Substack publication. He's written 73 editions to date, and believe me, it's a wealth of information about this subject matter. And he'll put up that the site or the email address. Actually, it's a website where you can sign up for that. You will gain enlightening and motivating insights, I promise. And also commit to our union and to, you notice I said our union because I am a union member, and to yourselves that all of our voices will be heard in Hartford and beyond. The status quo and the deep pockets of the multi-million trillion-dollar insurance industry, trillion, that's what it is, will make our goals and actions for change as difficult as they can. But I am confident that right will prevail over wrong if we use our voices incessantly, starting today. We will now have the organized numbers of voices needed to move the financial relief needle. We must work hard and fight hard. Thank you all for your attention. I am 100% optimistic that we will make some big noise, big and beautiful noise together over the following 6 to 8 months. David will now continue our session, and upon the completion of his material, we'll offer some general type question Q&A, because this is the meat and potatoes of the presentation. Thank you again for your attention, and now here's David.
Thank you, Ken. You're going to be a hard act to follow. Before I begin, I do have to make a quick disclaimer. I am not an attorney. The information that I present to you today is not to be considered legal advice. My comments are strictly my own and are based on my years of experience in the insurance industry, as well as the information that I have gathered through my years of investigating this issue. So the industry, the Connecticut Insurance Department, and our legislators want us to believe that this is a claim issue. Back in 2020, then Insurance Commissioner Andrew Mays held an informational session, and at that time, Genworth CEO Tom McInerney said that when the industry started selling this product in 1974, they really didn't have any information. They guessed at what they were selling, and that they needed 20 years in order to figure out what they were doing. Today, they say that there are multiple reasons that they need these increases. They say that people are living longer than they expected, that people held on to their policies longer than they expected, that the industry did not receive the interest and investment income that they expected, and most importantly, that the cost of care has risen much greater than they anticipated, which is causing them to pay much higher claims than they expected. They also tell us that they must have these rate increases, or there's a chance that they will become insolvent and then not be able to pay any claims. So let's take a look at each one of those excuses to see if they make any sense. So they say people are living longer than expected. Well, in 1974, they could have looked back 20 years because they said they needed 20 years of information. And in 1974, the average life expectancy of someone who was 65 was 78.5 years. If they had looked back 20 years to 1954, they would have seen that the expected age was 78.2. So in that 20-year period, the life expectancy for men age 65 only went up by a few months. If they had looked at 1994, when they said they had their 20 years of data, they would have found out that the average age increased again by 1.8 years to 80.3 years. And in 2024, the last year of information that's available, men at the age of 65 have a life expectancy of 19.3 years to 83.3 years. Now, here's the thing. If they had looked back to 1954 and saw that between 1954 and 1974, the average life expectancy had increased only 0.3 years and had applied that 0.3 years every 20 years, then by 2024, the average age would have been 79.4 years, a difference of only 3.9 years. That 3.9 years should not have been so great as to completely change their expectations. If they had waited and used the 1.8 years between 1974 and 1994, they actually would have been ahead of the game because the average life expectancy would have been only 83.9 years. And actually, the number for women is actually more favorable to the industry. So these small changes and discrepancies should not have caused this crisis. So clearly, people living longer isn't the issue. They say people are holding on to their policies longer than expected. Well, what the industry said was they anticipated that 5% of policyholders would get rid of their policies every year. And by the time people were old enough to need benefits under those policies, 80% of the policies would have already disappeared. Now, just as a general comment, that is a horrible business proposal that they're selling a product that they expect people to turn in. It's almost insulting to indicate that they don't think that the policyholders were smart enough to understand the value of what they bought, and as a result of that, want to keep it for a long period of time, especially when these people were told when they bought the policies, or they were asked if they would be able to pay their premiums if, for example, it went up by 20%. So this was just a false business premise. And the problem is that the long-term care industry based their analysis on mortality used in life insurance sales and not morbidity used in health insurance information. So people holding on to their policies really isn't the problem. They say that the industry didn't receive the interest rates that they had expected. Well, as an initial point, neither did the policyholders. But and we don't know what the industry used as their estimation for future interest rates. Today, they say that they expected between 7 and 9% interest rates on an annual basis. Well, that might be a fair estimate because in 1974, the average annual interest rate was 10.5%. But if they had looked back 20 years to 1954, they would have seen that the average annual interest rate was only 1.01%. That's a pretty good indication that there's a wide variation in interest rates over that 20-year period. And if they had waited the 20 years to 1994 to gather their information, they would have seen that the interest rate was only 4.2%. Again, wide variations. And in 1994, to anticipate that they would get 7 to 9% probably wasn't a fair estimate. So whether they look back 20 years or they waited 20 years to gather their information, they would have or should have known what reliable interest rates would be. So interest rates is clearly not the issue. They say they didn't receive the investment income that they expected. Well, between 1954 and 1974, when adjusted for inflation, the annual stock market rate of return was between 2 and 3.5%. If you use their 20 years to gather information between 1974 and 1994, the annual stock market rate was about 7.4%. And between 1994 and 2026, the annual investment return rate adjusted for inflation was only 7.75%. So if they had used 7.4% after their 20 years in 1994, they would have been pretty accurate. So the lack of investment income, the lack of interest income clearly is not the problem. They say that the cost of care is greater than expected. Well, the industry says that unlimited policies is the problem, and that's what drives up their claim costs. And unlimited policies are those policies that don't have a finite time period. I bought my policy in 2004, and it's a 3-year policy. It's got an average daily maximum rate, and it's got a total policy rate. But the daily benefit rate also applies to unlimited policies. So while the entire value of the policy might be unlimited, the amount that the insurance company will pay on any particular day is still fixed. And the insurance industry should have been able to understand what that would look like in the future. Now, it is true that between the early 1990s and the early 2000s, about 60 to 70% of all long-term care insurance policies were for unlimited benefits. But today, only about 10 to 15% of the policies that are still in force are unlimited policies. But here's the thing. The insurance industry likes to talk about the claims that cost them $1.9 million. That's probably the most expensive long-term care insurance claim that's ever been paid. But they don't talk about the other side of the equation, which is the cheapest claim they've ever paid is $20. And while the unlimited policy have the potential to have millions of dollars of liability, a study done by the American Health Insurance Program, released in August of 2025, estimates that for Connecticut, the average claim paid in 2024 was $231,000. And the estimated average claim for Connecticut, going back to when they first started recording this more than 20 years ago, was only $153,000. So what does that mean? Well, you may have a policy that's worth millions of dollars potentially, but the average claims are well within the limits of even the limited term policies that were sold to you and I. Another statistic that was reported by the American Long-Term Care Association points out that the average length of a claim is only 2.9 years, which means that even if you have an unlimited policy, the chances are you are still going to have a claim that only lasts a few years. So this is not a claim issue. If it's not, what is it? Well, I believe that it's a premium issue. And let's talk about what that means. Ken mentioned earlier the law of large numbers. It is the foundation of what makes insurance work. The industry knows that individual losses are unpredictable, but losses by a large group of people are stable and steady. And by pooling millions of risks together, the financial burden of a claim by some people is diffused across the entire group. The larger the pool of insured policyholders, the more accurately an insurance company can predict the frequency and cost of future insurance claims. An insurance company doesn't sell one insurance policy hoping that that person doesn't get pulled over for driving under the influence. They sell millions of policies, millions of the same policies, because by collecting all of those premiums, they know that while some of those people are going to have accidents and some of those people may drive under the influence, the larger majority that are paying premiums won't. That concept is what makes the law of large numbers work. And to really understand how this all got started, I'm going to ask you to take a little trip with me. And we're actually going to go back to London, England. The year is 1688. And in 1688, in this town of London, or the city of London, one of the most prominent things was coffee shops. In 1688, it was estimated that there were over 1,000 coffee shops. Some estimates say there were as many as 3,000 coffee shops across the city of London. And these coffee shops aren't that much different than what we have at Starbucks today. People of like mind would gather in the same coffee shops to discuss things. Merchants would go to one coffee shop and talk about their issues. Merchants or manufacturers of goods would go to another coffee shop. And there's one particular coffee shop that was located right on the banks of the River Thames. And it was owned by a man named Edward Lloyd. And while Edward Lloyd made his living selling coffee, his real passion was shipping. He loved to learn about the comings and goings of ships, what ships were going to carry what cargo, what ships were going on routes that were potentially safe and ones that might not be safe. And as a result of that, he started publishing a newsletter. And it would talk about the ships that were due into the ports of London, ships that were going out and when they were sailing and what they were carrying, and all kinds of interesting information. And because his coffee shop was right on the bank of the river, ship captains, ship owners, merchants, and financiers would all gather to talk about their shipping issues. Ship owners would talk about getting new ships and ships that were damaged and ships that they were sending out, and ship captains would talk about their routes. And there was a problem in those days because going across the ocean in ships was dangerous. And some ships made it and some ships didn't. And what Edward Lloyd did is help people understand that they could sell some protection to the ship owners and to the ship captains to help ensure that their ships were going to make it to the destination. And if it didn't, then the ship owner would be able to collect for the loss of the cargo or the loss of the ship. And Edward Lloyd had an idea. He started putting the names of the ships up on the wall of his coffee house. And some of the financiers who wanted to protect their investment would go over to the ship and they would write their name underneath the name of the ship. And in exchange for a fee that they would collect, what we know today as a premium, they would guarantee that if the ship did not reach its intended destination or it had some sort of an issue at sea, that they would pay the ship captain or the ship owner for the value of the cargo and the ship. And by the way, that concept of writing their name under the name of the ship is how we got the name insurance underwriter today. But there was still a problem with that because the few people that would put their name under the name of the ship still had the risk of, if that ship was lost, they would lose all of their investment. So they had an idea. If they started to sell a share and protect multiple ships, 2 ships, 3 ships, 10 ships, the chances that one of the ships might have a problem was greatly reduced because the other 5 or 6 or 10 ships would successfully complete the journey. And they would have the premium that they collected from those other ships in order to offset the losses that they had to pay. That is the essence of the law of large numbers, spreading the risk among a bunch of ship owners, and today it's policyholders, greatly reduces the risk and gives the capital necessary to pay the eventual claims. And by the way, that newsletter that Edward Lloyd started publishing is still published today by the company that grew out of his coffee shop that we know as Lloyd's of London. So, as I said, the concept of spreading the risk is what the law of large numbers is all about. The more policies sold and the longer policyholders pay premiums, the more money the insurance company collects to pay future liabilities. Here's the problem. The long-term care insurance industry violated this foundational concept by closing these policies to additional sales after only a few years. I mentioned that I bought my policy in 2004. It's from Genworth. Genworth started selling that policy in 2002. What I didn't know when I bought the policy is that they were going to stop selling it in 2005. So in a little under 4 years, they sold a few thousand policies. Unfortunately, for the next 20 years, they have not had one more new policyholder join the ranks of those couple of thousand people that bought that policy. We have basically been asked to self-insure, to pay enough premium amongst us to cover all of our potential claims. This is no different than what those financiers understood in Edward Lloyd's coffee shop. You can't just insure one ship and hope it's successful, because that one ship may have a problem. But if you insure many ships, or in the case of today's property and casualty insurers, if you insure millions of automobile policies, the chances that you have to pay claims on just a small percentage will help have the finances to cover those losses. Without the additional policyholders paying into these policies for the 20 or 30 years, there was never going to be enough money to pay for future claims. Now, the industry claims that they closed these policies very early because they realized their mistakes, and then they opened new policies that they held open longer. Well, in my case, they held the policy open for 4 years. The policies that Genworth offered right after that were offered for about 7 or 8 years. The longest policy I've ever seen is 11 years. But the fact still remains that all of these policies, and it's not just Genworth, it's Transamerica, it's John Hancock, all of these policies were closed too quickly, which causes them to have a shortfall of premium to pay future claims. Now, the actuaries in these companies all knew about the law of large numbers well before they started selling long-term care insurance in the mid-1970s. They knew, or they should have known, the impact of closing these policies to new business would have been catastrophic. And if anyone thinks that the industry learned its lesson early on, I would ask them to look at a policy sold by Prudential Insurance Company in 2012 here in Connecticut. This policy was sold from March 2012 to July 2012. 4 months. They sold 25 policies, and then they closed it to new business. Today, only 16 of those policyholders still have their policy. And Prudential, which already had gotten a 62.1% rate increase, recently wanted another 14% to cover their claims. Now, the insurance department did deny that, at least for now. But Prudential has vowed to come back and ask for more rate increases of even higher amounts, because they said there is no way that the 16 policyholders can generate enough premium to cover their future losses. Edward Lloyd would have told them that would be a problem. Ladies and gentlemen, this is not a claim issue. This is a premium issue. There's 2 more things that I'd like to talk to you about. I don't want to get into too much granular detail, but I think this is important. And the first one is called reinsurance. And just as insurance companies spread the risk across many policyholders, insurance companies also buy insurance. This is known as reinsurance. Now, reinsurance is an industry all by itself. We could spend weeks talking about how reinsurance works and the multiple different types. But just understand that an insurance company decides how much of a risk they want to absorb, how much can they afford to pay before they need insurance themselves. It's no different than we decide how much of a deductible do we want to pay if we have a fire in our home or we have an accident with our car and we have to pay to fix it. Insurance companies have their own deductibles, their own amount that they decide they can afford to pay. And then they go to a reinsurance company and buy reinsurance to cover that additional exposure. Now, I said that the reinsurance industry was complicated, and it's true because reinsurance companies then go out and do the same thing and decide that they are going to buy insurance to cover their unexpected exposures. Those reinsurance companies, for the reinsurance companies, are known as retrocessionaires. And I mention that because the poster child of reinsurance is Bright House Insurance Company. And before I talk about that, I think it's important to mention what the Connecticut Insurance Department says about reinsurance. Because when you hear about Bright House Insurance, you're going to wonder, why has the Connecticut Insurance Department allowed this? And what the insurance department says is when these original long-term care policies were sold, they did not contemplate whether they would have reinsurance. And if the reinsurance companies are unable to pay their claims to the insurance company, then the insurance companies need these rate increases in anticipation that they may have to pay those claims. So let's talk about Bright House Insurance. Back in 2024, Bright House Insurance filed for a rate increase. And in their initial filing, they stated that since 2008, Bright House Insurance has had 100% reinsurance from Genworth Financial. And Genworth Financial had 100% retrocession with a company called Union Fidelity Life Insurance Company. Now, it's important to understand that Bright House Insurance policies originally were sold by Travelers right here in Hartford. After a certain number of years, Travelers decided they didn't want to be in the long-term care insurance business anymore. They renamed the company MetLife of Connecticut. They bundled all of their long-term care insurance into MetLife of Connecticut. That ultimately became Bright House Insurance, and it was ultimately spun off into a separate independent company. What that filing in 2004 said was that for every dollar that Bright House Insurance paid, they got that money back from Genworth Financial. Genworth Financial then turned around and got that dollar back from Union Fidelity Life Insurance Company. And again, the insurance department says that, well, if Genworth is not going to be able to pay their claims to Bright House Insurance needs to get these rate increases. Well, what's actually happening then is that Bright House Insurance is getting rate increases from people here in Connecticut, reporting that they have these massive losses in the millions of dollars when they actually haven't spent any money at all because they've gotten all of their money back since 2008. The insurance department says they need to make sure that Genworth can pay the claims. Well, Genworth gets all of their money back from Union Fidelity Life Insurance Company, who, by the way, is owned by a company known as Swiss Re Insurance. And Swiss Re is the largest reinsurance company in the world. They currently have about 188 billion with a B dollars in assets. That is their business, just reinsurance. They know it very well, and they do it very well. But the question becomes, are all of these rate increases that Bright House is getting actually legal? Because under the Connecticut statute, A policy, a long-term care policy, has to have a minimum loss ratio of 60%. That means that for every dollar collected in premium, 60% has to be paid in claims. These policies were approved by the state of Connecticut Insurance Department with a guarantee that they would have at least a 60% loss ratio. Well, if Bright House Insurance is getting all of their money back from Genworth, how can they have a 60% loss ratio? And if Genworth Financial is getting all of their money back from Union Fidelity, what are the chances that Genworth is not going to be able to pay the claims filed by Bright House? I questioned the insurance department about this practice. And I specifically asked them, well, at the end of the day, when the last claim of the last policy is paid, how will you know if this policy has a 60% loss ratio? How will you know if Genworth ever stopped paying their reinsurance obligations? And how will you know if the policies meet the minimum 60% loss ratio requirement? And the answer I got from the insurance department was, your questions are speculative and we will not respond to them. Well, I would suggest that their answer of, in case Genworth can't pay their claims, or Union Fidelity can't pay their claims, is equally speculative. The other thing is that the policyholders here in Connecticut have a contract with Bright House. They don't have a contract with Genworth. They don't have a contract with Union Fidelity. And the policy that they have a contract with does not have a loss ratio of 60%. So I seriously question whether or not this is even legal. And if 2024 wasn't bad enough, Bright House recently filed again in 2026 for another rate increase with the same information confirming that since 2008, they have had 100% reinsurance, and acknowledge that Union Fidelity Life Insurance Company is the ultimate risk holder. That's the words they used, the ultimate risk holder for these claims. One of the things I mentioned in the beginning is the reasons that the industry says they need these rate increases is insolvency. And I saved that till the end because I think it needs special attention. So the insurance department and actually our legislators say that insolvency is a major concern. They say that people won't be able to buy long-term care insurance if these companies go insolvent. Well, as a matter of information, the legacy industry of the policies that we have ended around 2016. The companies that hold these policies today never did and don't currently sell long-term care insurance in Connecticut or anywhere else. These companies were created to hold these money-losing policies intentionally so that the industry could say there isn't enough premium coming in to cover claims. We have to have the rate increases. And these companies have been structured in such a way and so many layers below the corporate parent that it is impossible to know what their financial situation is. The insurance department and the legislature says that if these companies go insolvent, it's going to create a burden on the Connecticut Guarantee Fund, which would have to assume the liabilities, and the amount of money is massive and they wouldn't be able to handle that. Well, the Connecticut Guarantee Fund, like every other state, is financed by all of the insurance companies that sell insurance in the state of Connecticut. And what the state guarantee fund would do if Genworth or any other company went insolvent is raise the premium that the remaining insurance companies have to pay. It's one of the reasons that the insurance industry polices itself and tries to make sure that their other companies don't go insolvent, because they don't want a reason to have these rates increased. What the insurance department and the legislature doesn't want to talk about is Medicaid, because there are currently 100,000 policies here in Connecticut. If each policy has a claim of $200,000, that's $20 billion of liability that shifts to Connecticut Medicaid. Now, we already know that the governor and the legislature are in crisis mode because of the Medicaid cuts that are coming from the federal government. If you expose Connecticut Medicaid to an additional $20 billion of liability, there's going to be all different problems that come up. And it's important to remember that this was set up by the insurance industry. I pick on Genworth because I have their policy and I know a little more about them, but the same holds true for most of these companies. And what Genworth did back around 2013, 2014, when they first started these rate increases, is they took all of the long-term care insurance policies in Connecticut and they created a company called Genworth Life Insurance Company. And all of these long-term care policies were put into that company. Well, what's the problem with that? The problem with that is that you've got all of these underfunded policies that don't have enough policyholders paying premiums that are now starting to pay claims because the average time between the time that someone buys a policy and someone files a claim is somewhere around 17 years. So many of the people who hold policies today that need coverage are getting coverage. You've got all of these policies that are underfunded, overweighted in their liabilities, all sitting in one insurance company that isn't collecting enough premium. If Genworth Life Insurance Company becomes insolvent, it's because their parent organization, Genworth Financial Incorporated, which has billions of dollars of assets and a CEO that earns approximately $9 million a year in compensation, wants them to become insolvent. This is not a claim issue. This is a premium issue. And what about the financial structure or well-being of this industry? Is there really a chance that a company like Genworth or John Hancock or any of the others could go insolvent? Well, today, the total assets of the U.S. insurance industry is about 13 trillion with a T dollars. That's broken up between property and casualty, which is things like automobile, homeowners, general liability, workers' compensation of $3 trillion. Life and health, which is technically where long-term care belongs, which is $9.3 trillion. And health insurance, which is the annual health insurance that many of us buy, which is about $704 billion. So if you roll health insurance and life and health together, you're talking about a $10 trillion industry. Long-term care insurance as an industry represents about 1.5% to 2% of that $10 trillion industry. If these companies go insolvent, it's only because their parent organizations want them to go insolvent because they don't want to use the money to protect the policyholders. They want to use the money to protect their shareholders and their executive compensation. I'd like to leave you with a couple of final thoughts. If you found this interesting and you think that you have friends and neighbors that would equally find it interesting, we present a similar seminar and have been doing it and will continue to do it at senior centers and public libraries across the state of Connecticut. If you think this is something that your town would be interested in knowing about and your residents would be interested in knowing about, I urge you to talk to the senior center, the public library, religious organizations that might want to have a public speaking. We would love to be able to come to your town and present this as we have today. And I believe they're putting a web address up in the chat. It's ltcicrisis@gmail.com. You can write to us if your town is interested, and we can make that happen. People ask me a lot, well, can I really do anything? I'm just one person. Or, it's me and a few of my friends that have these policies. Is there really anything that we can do? And my answer to that is best said by the American anthropologist, author, and speaker Margaret Mead, who said, "Never doubt that a small group of thoughtful, committed individuals can change the world. In fact, it's the only thing that ever has." Thank you for your attention, and now I'm going to turn it over to Jan. Oh, I'm sorry. No, back to Ken.
Back to Ken. You got me again. I need your attention for just, I know you've been very attentive for the last almost hour, and I'm going to talk about Public Act 2396, which is the law that was recently passed well, actually, the bill that was passed into law. And again, it'll just take me about 7 minutes. So if I can have your attention, I'll run through this. I'm not going to get down into the weeds. I'm going to keep it at very high level. But I want you to know also that I've tried to eliminate all legalese verbiage from my remarks. I don't like it. I will first share what we asked for in our very specific 2026 bill proposal. Jan, David, and I put our heads together and we said, what do we want from the legislators? And let's see here. And we'll 10 propose and then try to tell you what we got. Yes, we're going to tell, excuse me for fumbling here. But we're going to tell you what we wanted, and then I'm going to tell you what we got. With this approach, you will better understand why we describe PA 2693 as being a foot in the door law as opposed to being finished. In a nutshell, there are two words that describe the nature of our request. They are specificity and relief. Also, in a nutshell, there are two words that describe what we got. They are ambiguity and deliberation. Our proposal elements included the following. I'm going to run through them very briefly. Number one was a holdover from the law that already exists, and we did this for continuity purposes. But if the policyholder is under 65 years of age, then increases are to be spread over 3 years or more. Number two, part of that is no more increases requests filed during the chosen period after you get that approval on that one increase request, and that there will be a single percentage that is to be applied to that will represent the increase for each year of the chosen period. Now, number two element in our list of asks is that if you are 65 years of age or older and had your policy for at least 15 years, then you are eligible to have your increase capped at the same amount as what the consumer price increase was for the previous year. That's known as a CPI. So it would be capped at that rate. If it did exceed 10%, if the increase that was approved did exceed 10%, remember, it will be capped, but the extra percentage points will be spread out over future years until that's paid up, so to speak. But your yearly increase will never exceed 10%. And we did this because we thought with the 65 years of age, that pricing stability needs to follow policy longevity. Now, our third point for all policyholders, that there would be zero long-term care increases should be approved for any rate increase once the premium rate equals 300% of the original policy premium paid, regardless of any decrease in premium due to the policyholder decreasing benefits. Many of us have decreased our benefits because we couldn't afford the premiums. Well, what this point would have done is said you're going to get total credit for what your premium would have been had you not taken that reduction. And so when you reach $300,000, then 300% of the original policy premium, then all bets are off. Now, this would be big because increases up to 300% is an undeserved reward for the insurers that deceived us with suggestions that our level funded policies, as David mentioned, might increase by 20% over their lifetime. And we know that was bunk. Number 4 point, insurers must demonstrate that they sold enough policies in Connecticut to produce sufficient premiums needed to substantially cover the anticipated losses. Failure to produce such proof will result in ineligibility for increases now and in the future. That's a pretty harsh ask. This would also be a very big item that we would have liked to see. However, insurers would be required to prove numerically that they did not violate the industry's sacrosanct law of large numbers that David spoke about. Did they have enough policyholders? Number 5 point under our ask was that they must disclose all reinsurance agreements that the specific policy forms affected by for the specific policy forms affected by the rate increase. So you heard David talk at length about reinsurance. So we want to dig deeper and know what's going on. So my comment there is that insurers may have secured reinsurance policies, like David said, on our policies using our premium dollars to cover the cost, and then filed claims and received claim payouts from reinsurers to cover their loss, which is not really a loss if they were reimbursed and made whole, is it? If they had requested a premium rate increase claiming a loss, are they not, and perhaps the CID, the insurance department, violating Connecticut Statute 38A501, which says that only actual losses may receive consideration for premium rate increases? What Public Act 2693 delivered to us is very nebulous and discovery based. By discovery, I mean there's a lot of learning they want to do. Its elements deliver vague expectations for insurers and the Connecticut Insurance Department officials. It is effective July 1st, 2026. However, insurers and the CID need not start their to-dos work till October of 2027. So that's, it's over a year from now. The legislator's Public Act 2693 includes the elements that follow. Establish new annual reporting requirements for insurers and Connecticut Insurance Department on long-term care insurance actual paid losses separate from incurred losses. So they did get it right that they know we're interested in knowing what the actual payments losses are versus what they're estimating. They have the right to estimate losses now without having realized those losses at that point in time. So this element could be very helpful for our cause if the data, which will be aggregated and de-identified, that's in the law, which kind of means that they're lumping it all together. If the data does not lose significant meaning and value because it's no longer sufficiently granular. So that remains to be seen, and there might be something there. Number 2 provision of the law is that allows the insurance commissioner to report on the feasibility and the effect of certain requirements on long-term care insurance, such as the impact on reinsurance on future long-term care insurance availability and the impact on the insurance companies if they offer a return of premium or a buyback for giving back the policy. Now, here's my comment. Another discovery exercise with no opportunity for immediate financial relief. But there will be some work done, and we'll do our best to pick into that to find out what is going on and to have them report back. Number 3 is that it authorizes insurance commissioner, our insurance commissioner, to investigate and take disciplinary action against long-term care insurers that violate state long-term care insurance laws. My comment to that is we believe that they always had that power, but just haven't used it. And number 4, lastly but not leastly, the new law authorizes the commissioner to refer to the CID investigation to the Attorney General for further action if warranted. And again, my comment is this has a lack of specifics and granularity, leaves much subjectivity and leeway to the insurance commissioner. There needs to be specific and detailed written criteria that enumerate the basis for said investigation, along with the commissioner's detailed written responses. So that's kind of the long and short of it. It's really the short of it, and I wouldn't want to bore you with the long of it. So at this point, again, if you have any questions to that, and hopefully I didn't put you to sleep, but if I did, Jan will wake you up here, because I want to thank you all for your time and your attention. And now I'm going to turn the program over to Mrs. Jan Kritzman on her 57th wedding anniversary. Okay, let's get you here moved over for Jan. Okay, Jan, there you go. Raise your mic.
Okay, I'm going to do this. Good afternoon, members of the CSEA Retirees Union. My colleagues and I are grateful to Kevin Sullivan. Thank you, Kevin, for inviting us to speak to you today about what has become a critical, financially ruinous situation regarding the long-term care insurance policies that you purchased, believing that you could affordably protect yourselves against any future costs of long-term care. My name is Jan Kritzman, and I live in Newington. My husband and I are self-employed. For the past 23 years, we've had long-term care policies, each of us, from Transamerica Life Insurance Company. It's an enormous company with net assets of $416 billion. We figured we needed long-term care coverage, and this policy was, quote, certified by the state of Connecticut Partnership Plan. What could possibly go wrong? Instead, we would wind up buying a policy of pretense. 50% of us are going to need long-term care. That's you, not you. You, not you, you, not you, and you. At $15,000 a month for a nursing home bed, this kind of cost could quickly wipe out one's savings and cause financial heartache for a surviving spouse and family. Without a long-term care policy, after your savings are wiped out, your family must go through the process of applying for Medicaid. Not fun. Hello, Medicaid. Thank you, taxpayers of Connecticut. Medicaid is welfare. Now, you retired state employees are the people that basically ran the state of Connecticut. You were the engine that made sure 3.5 million Connecticut residents successfully received all the services our tax dollars paid for. You put in your time, your effort, and your heart. You didn't work for Connecticut for 30, 40, or more years to ultimately go on welfare, did you? So many of you planned ahead. You bought the long-term care insurance policies in good faith. The premiums at the time were somewhat expensive, but doable. I don't know exactly when the premium debacle began. Maybe it was around 8, 10 years ago. Our premiums doubled at that time, and then they doubled again. What was $1,000 a year premium per person in 2004 for us is now almost $4,000 a year per person. And that's after paring down our policy benefits. That's almost a 400% increase, and that is financially injurious. And a lot of policyholders that I've met have experienced much more significant increases than that. It was serendipity a few years ago that Ken and David and I happened to meet. Instantly, we realized that correcting the injustice perpetrated upon us by the long-term care insurance industry was going to be a long-term collaboration. We each have diverse backgrounds and approaches, but we share one goal, and that is to expose the long-term care insurance industry for the miscalculations and short-sightedness they are guilty of. And now is the time and place to compel them to own up to it, pay for their own dreadful mistakes, and not look at us as scapegoats to bail them out. Imagine these long-term care insurance companies are each a division, a separate entity of multi-billion-dollar insurance behemoths. They are the losing division, always crying poverty. Why don't the larger, wealthier divisions lend them support? I can only guess. Meanwhile, the long-term care divisions are picking our pockets and bleeding us dry. And most of them have reinsurance to boot, which you've heard about from David. No need to worry about any of them going insolvent. That's a myth. They pay out a claim, they collect reinsurance. The reinsurance companies collect reinsurance. I've been asked, why are you doing this legislation? Why are you lobbying at the Capitol, testifying before 7 different public hearings? The answer is simple. I'm a citizen lobbyist. I'm pro bono. I'm campaigning against the miserable premium rate requests from the long-term care insurance companies who expect us, the victimized policyholders, to pay for their miscalculations and short-sightedness. Take note. I'm not doing this just for myself. I'm here for all of you, all of us who are being punished by what I call the trickery by these companies who, shall I say, conveniently stopped selling these policies about 12 to 15 years ago and now cry poverty and raise our premiums mercilessly every year. No new policyholders, no new premiums coming in. So we legacy policyholders get slammed with paying for their screw-ups. Question. Did they all make the same miscalculations at the same time? Interesting. You know, I'm quoting one of their brilliant actuaries who said, "We didn't expect you all to live so long." They expected us to quietly go off to pasture, buy the farm, and never put in a claim. Well, excuse me, I didn't mean to live so long. They want us to abandon our policies because the premiums are too high and throw away all the money we've invested in the premiums. Well, I say, not so fast. Try this one on. I bet some of you are old enough to remember the 1976 movie Network. Peter Finch played news anchor Howard Beale, who had an on-air meltdown and screamed the famous lines, "I'm mad as hell and I'm not going to take it anymore." Finch died shortly after the movie release, but posthumously, he was awarded the Oscar for Best Actor. Not a surprise. Timely, huh? Let's adopt that as our battle cry because we too are mad as hell and we're not going to take it anymore. Public Act 2693 is what we've all called here a foot in the door law. Now we have a law, the do's and don'ts of which have been explained to you today. It needs meat on its bones and a big protein shake. Example. Make premiums eligible for either a tax deduction or a tax credit. Eliminate the sliding scale for income on which these tax proposals would be based. It's worth a try. Strengthen the concept of tying premium rate increase requests to the cost of living index. Change the word may to shall. That means they got to do it. I'd like to hear your suggestions too. A powerful House rep recently told me that to get laws passed, I would need an army. Lots of people, lots of emails, phone calls, and voices so deafening and thunderous that we will get the most powerful law here in Connecticut to curb the ability of these long-term care insurance companies to pick our pockets. We will be the mouse that roared, and the long-term care insurance companies' walls will come tumbling down. Ideally, I want you to join our confidential database by emailing us at LTCI crisis, that's long-term care crisis, LTCI crisis at gmail.com. Provide your name, your town, your email address, the name of your long-term care insurance provider, and the names of your state rep and your state senator. Also, please subscribe to David's Substack postings at long-term care crisis at substack.com. Very, very interesting. He writes at least once a week an article that you've got to read. There you can request David's 97-page white paper at longtermcarecrisis@gmail.com. I know 97 pages sounds like a lot, but it's a good, quick read and you'll learn a lot. To attend public hearings, lobbying efforts, and possible press conferences at the Capitol next session, we will send you an email blast with date and time. I also want you to sign up for emails regarding long-term care insurance premium rate increase requests from the Connecticut Insurance Department. For your information, this state office has the power to say yay or nay to premium rate increase requests. Email them at cid@ct.gov. That's cid@ct.gov. We're watching them closely. They have a new commissioner whom we are hoping will favor long-term care policyholders over the long-term care insurance companies. The recent retiree from the position of commissioner really did not. In your hip pocket, have a short testimony prepared at all times explaining how rising premiums are destroying your plans for securing your financial future. We may contact you on short notice, like the Minutemen, to be available to make your voice heard at the Capitol. By the way, my email is coinman1, that's COINMAN, numeral 1 at cox.net. In conclusion, folks, get ready to make headlines. Thank you, Kevin, and many thanks to you, our future Army.
That was fantastic. Thank you so much. I know Betty Marafino has had her hand up since almost the beginning of the presentation, so thank you for being so patient, Betty. Do you have a question? Oh, we're just going to ask you to unmute.
Okay, can everyone hear me?
Yes.
Yeah.
Good. That was fantastic. And I'm president of the Connecticut Alliance for Retired Americans, and the Amelia Smith you mentioned is also on our board. And I testified at the hearing and saw some of you. And let me say, for the Connecticut Alliance, this was a priority issue and will continue to be a priority issue for us. So Jan, I think we're ready to join the Army, and anything you can do, and to guide us we would really help it. But I wanted to say, I think it was about 3 years ago, I went to a meeting called by Senator Chris Murphy. It was in Newington at their town hall. And the only topic was long-term care insurance. Maybe some of you were in the room, and he was gathering stories of Connecticut residents who were suffering under their policy. Has there been any talk with him or with Senator Blumenthal about how they could maybe in-state aid this along?
So I can speak to that. I think I might have been at that Newington meeting, and I actually spoke to Senator Murphy after the meeting concluded. What he said to me, right, and he's correct in saying this, is that insurance is regulated by the states, and on a federal level, there isn't really anything that he feels he could do. In addition to that, I have written to Senator Murphy and to Senator Blumenthal on multiple occasions, bringing them new information each time that I write about what is going on and some of the examples that I talked about today. The response I've gotten back from them is that this is an important issue. I've raised some good points, and they will certainly keep it in mind if an opportunity arises for them to do something more about this. Like we do at the state level, I think it's important that the more people that reach out to our federal representatives and our federal senators, the more they're going to understand that this is something that they need to pay attention to.
This is Maureen. I do have a concern myself. I purchased my insurance from Travelers while I was working at Blue Hills Hospital before I went to the state of the State Department. And it was only about 90 something dollars, I thought it was. And as I was listening just now, I remember getting different letters every quarter, Genworth, some of those names that you talked about, until it came down to Bright House. So I must have had at least 4 changes that you mentioned until it came down to Bright House. So I said to mine is paid quarterly, and they have raised it at least 3 times. I got a letter a year ago indicating that my last raise was the raise that they did. $897 and some change every quarter. And so I called and I said, this is really cost prohibitive. Can I get my money back? I didn't really know how it worked. And she just said, well, if you do decide to cancel it, we keep all of your money. I was floored. So I am now still paying $897. And I am hoping that there's no more raise, because they indicated that it would be 3 raises, and it went from like 600 and something to 700 and something, and now $897 every quarter. So I just really glad that I heard about how they do sell these insurances, because they don't have enough clients in their in their business, and then raise the prices so astronomically. I need to call them again and tell them what I hear.
Mark,
And I
thank
don't know.
you for your information and sharing that. I think everybody here has the same situation and experience. And I can see in the chat that there's a lot of concern from people in the same situation as you. And I don't want people to panic at this point. I think a lot of people are panicking and saying, well, should I just get rid of my policy? Should I just get rid of my policy? And I don't think that's what anybody should do at this point. I think fighting first and trying to go through the legislation process, working with this group, the LTCI crisis. I'm not sure if that's the name of this group, but I know that's the Gmail. I think what the best course of action for us to do is share information with all of our members. This presentation is going to be on the CSEA website, so we can watch it again. You can come back to it to understand the history of how it happened. There was so much information presented today. It's been very informational. And we'll share as much information as we can with our members, and just remind them, don't panic. Let's all work together to try to stop this, and be mad as hell, and we're not going to take it anymore. As Jan said, that's perfect. So I just wanted to say that, because I don't want people to panic and do the wrong thing at this point. Let's work together to fix this. And I know a lot of people have questions that we weren't able to answer because we simply ran out of time, unfortunately. But we will keep everybody apprised of everything that the group has to share, and anything that we could do legislatively. But I think also in the meantime, reaching out to your representatives, your senators, your state senators, your congressional delegation is the best next steps.
Hi, this is, I have my hand up. I'm Minati Roy Chaudhary. I just wanted to, I know the presenter mentioned about Genworth a lot, and we found out, how it goes down, and you come to the real company actually owning it, and very hard to get hold of. He didn't mention anything about Trans America, which we got through the state, both my husband and myself. And we have already got notification for 26, and his premium has gone up by $112. We pay quarterly to $1445.50, and for 27, they've already given us that it's going to go up to $1710 projected. So, I mean, this is outrageous. We got our policy 25 years ago in 2001. So we are appalled. When I have gone for my meetings, retiree meetings, we've talked about this, and this is becoming highly unaffordable. Yet we feel we are kind of in a bind. We have paid for 25 years. And now suddenly to get out, we lose everything.
Yep.
So there's nothing we've got from them. We've never had a claim.
They would say that you could have gotten something from us. That's their line, is that if you did have a claim, you were covered, which to me is a smart answer, and it really doesn't address the problem. And that's why we must come together, and we must just relentlessly keep putting it in their faces and embarrass them. They should be embarrassed as to what they are doing to the people of this state, the elderly people of this state, some of the most vulnerable people. It's totally unconscionable. And the only way we can do it, because we've tried, is they listen, they nod their head, and then don't do anything. So until you get enough people that are standing in front of somebody's office and saying, hey, we're not, what's the line?
We're mad as hell and we're not going to take it anymore.
Yeah.
Yeah.
I mean, it's an individual. David's line about Margaret Mead, it is a grassroots, and that's what we can do. We can sit around and we can talk about it and really share stories and say, oh, that's terrible. And that's terrible. And it is terrible. But unfortunately, the way things work in this state and in this country, mostly work, is that you got to go through a process, and we just need to show the numbers and swell and just make them make it so they can't ignore us, period.
And Margaret, I'm from Newington. I'll be very happy to work with you. Just
Thank you. Terrific. Great.
Yep.
I've been doing pro bono lobbying. I hate to say how many, 45 years. And I'm responsible for passing 5 different pieces of legislation, 5 different laws successfully. Every single one of them started with a foot in the door law, which was like willy-nilly and wishy-washy and no big deal. And then I had to go back the next year and try to fatten it up. And sometimes that didn't work. And then I'd have to go back the next year and fatten it up. And sometimes it took me 4 years on one particular bill to get it the way that it would work, that would help people, that we wanted it that way. So be prepared, gear up, okay, fasten your seatbelts. This could take a couple of more years. In the meantime, I suggest whatever you can do to hold on to the policy and pay the exorbitant increases. Whatever you have to do it. Because if you drop the policy, what have you got? A loss of thousands of dollars in premiums. And then you don't have long-term care. Yeah. And now we're looking at Medicaid, which, like I said, is welfare. And you didn't work for the state for that many years to go on welfare, did you? No.
So if I want a presentation, because I'm also part of my senior center here, I'm a member.
In Newington?
Yes. So I would love for this presentation to be done at the senior center. And whom should I contact?
I think, last summer, David Schwartzer here to my right did a seminar on the long-term care insurance crisis at the Newington Senior Center. And it was very well attended. There must have been 25 or 30 seniors who were very interested in what he had to say. I'm going to suggest to David right now that he go back to the Newington Senior Center. There seemed to be quite a bit of interest, and do another one of his seminars. He's done 6 or 8 of them this year, all around the state of Connecticut. And a lot of them are very well attended, but Newington had the most attendees, I'm happy to say.
Yeah, yes. I mean, the senior center at Newington is awesome.
Yeah. Awesome.
Yep. And I would say anybody interested to have this done in your own town, in your own senior center, if you're not a resident of Newington. By the way, I am also. Maybe that's how I recognize you, Jan. Or you
yes.
But you can reach out to your senior center and ask if they would consider holding a seminar. And contact ltcicrisis@gmail to reach out to the speakers. And I'm sure they're very willing to work with everybody, it sounds like.
Mm-hmm.
All right, so
We-
thank you,
We
everyone.
need your emails.
Yes, it is 5:30, and I want to thank Ken, David, and Jan for all of the great information that they provided tonight. If you didn't get your question answered, you can send it to that email, or you can reach out to me and Bernadette, and we'll get those questions answered as best we can. I know there was a lot of information tonight, and like Bernadette said, you're able to rewatch them. One final thing, for those of you that live in Connecticut, we will be kicking off our campaign season on July 7. So there's many opportunities for you to get involved all over Connecticut. We'll be working hard for the candidates that have pledged to work hard for you. So send me an email or give me a call and we'll get you plugged in with one of our endorsed candidates. All right. Thank you everybody for attending tonight. We appreciate everybody showing
Kevin,
up and
1
supporting
second.
CSEA.
Kevin, could you kindly send, I'm in the Four Cs, a retiree. I was wondering if we could get the list of candidates that have been endorsed by the union, please.
Yes, it will be sent out and it will be in the CSEA news.
All of that
Fantastic.
information is in the CSEA news. Always watch, look in the CSEA news for our endorsed candidates and
All
reach
right.
out to them and talk to them about this subject.
Absolutely.
Yes.
Oh, I just met Representative Larson, and of course, just,
Very good. He
He's
is an
good.
endorsed candidate of CSEA.
yeah, I know that. Yeah.
All right. Thank you, everyone.
All right.
Thank
Thank you very
you.
much.
Thank you.
Wonderful
Thank you.
presentation. Thank you.
Thank
Have
you.
a great night.
Thank you.
Thank you.